All right, welcome back to the deep dive. We're diving deep this time into Morgan Housel's The Psychology of Money.
Oh, yeah, we've got excerpts from a bunch of chapters. It's going to be a good one.
This book, it really digs into the why behind our money choices. Sometimes those choices, they don't seem to make a lot of sense.
It's not always about being a spreadsheet wizard, is it? Sometimes it's emotion, sometimes it's just plain irrational.
Totally. So we're going to go on a quest here. We're going to figure out what makes us tick when it comes to money.
Exactly. Like, how does our background, all our experiences, even those hidden biases we might not even know about, how does all that play into our money decisions?
Right. Okay, so let's jump right in. Chapter 1. No one's crazy. The chapter throws out the whole idea that there's only one right way to think about money.
Yeah, like, forget the rule book. Housel's saying everyone's different. We all come to the table with our own set of experiences that shape how we see money.
I get it. Like someone who lived through, say, the Depression, they might be way more cautious with their cash than someone who's like a young entrepreneur who's seen people make millions overnight.
Exactly. It's all about perspective. Neither one's wrong. They're just different.
Okay, so that leads us to the story of Ronald Reed, right? The janitor who ended up leaving like an $8 million fortune when he died.
Yeah, that story always blows my mind.
I know. You'd think you need to be a Wall Street hotshot to build that kind of wealth.
And that's Housel's point, right? Ronald Reed, he just lived simply, invested consistently, and let time work its magic.
So it's more about behavior than like being a financial genius.
Totally. Patience, consistency, that's the secret sauce.
He was the tortoise, not the hare. Love it. Okay, on to chapter 2. We've got luck and risk, which sounds kind of deep.
A little philosophical, maybe. This chapter really dives into how much luck and risk are intertwined. It's more than we often realize.
So are you saying that even the most meticulously crafted financial plan can get derailed by a random event?
Absolutely. Think about someone diligently saving for retirement and boom, a sudden illness wipes out their savings. Or imagine winning the lottery on a whim. Talk about extremes.
Yeah, it's like we love to celebrate the big wins, but we often forget about the role luck played.
And we also tend to judge failures too harshly. Like, maybe that business that went under, maybe it wasn't bad management. Maybe it was just, well, bad luck.
Right. It's all about perspective. I remember Housel using the example of Bill Gates, how he had access to a high school computer lab way back when. That's like winning the lottery in a way, right?
Totally. That one lucky break gave him a huge advantage in the whole tech boom. Makes you wonder how many other brilliant minds never got that same opportunity.
So it's a mix of hard work, skill, and a little sprinkle of luck.
Exactly. But we can't control the luck part, can we?
So what can we control when it comes to risk?
Well, we can diversify our investments, have that emergency fund ready, not take on crazy debt, that kind of thing.
Okay, I see it. We're not just talking numbers here. We're talking about our mindset,
Yeah.
how we handle the ups and downs.
It's the psychology of money, remember. All right, now brace yourself, because chapter 3 is never enough. This one's a reality check about ambition.
Never enough. Oh boy, I know some people like that. Always wanting more, more, more.
Yeah, and Housel tells the story of Rajat Gupta. This guy was a wildly successful businessman, but got caught up in insider trading trying to reach, billionaire status. Threw it all away.
Oh, that's a cautionary tale for sure.
Yeah.
It's like no matter how much you have, it's never enough.
Yeah, that's that grass is always greener thing, but with money, the goalpost keeps moving, and people get stuck on this treadmill of wanting more.
It makes you think, when is it enough, right? When do you stop chasing?
That's $1 million question. Each of us has to figure that out.
Yeah. Okay, well, speaking of millions, now we're getting to the good stuff. Chapter 4 is confounding compounding. I love this chapter.
This is where it gets really interesting. This is about exponential growth, and Housel compares it to, get this, an ice age.
The Ice Age.
Yeah, just like tiny snowflakes building up over time to make these massive glaciers. Small, consistent investments can grow into a mountain of wealth.
Okay, I get the analogy, but I've got to admit, compound interest has always felt kind of abstract to me.
I hear you. Okay, how about this? Imagine investing $1,000 today. Modest 7% return each year. After 10 years, it's almost doubled. and you barely did anything.
Whoa, okay, that's making more sense. So it's like, my money is working for me, even when I'm sleeping.
You got it. And the longer you let it ride, the more dramatic it gets. Over 30 years, that same $1,000 could be worth almost $8,000.
Okay, so I'm starting to see the magic here. Slow and steady, just like that tortoise.
Exactly. Starting early and being consistent, that's the real secret to building wealth.
This is making me rethink my whole approach to saving. Okay, what's next?
All right, buckle up, because Chapter 5 is getting wealthy versus staying wealthy. Housel threw the curveball here. He's saying that making a fortune and holding onto it, they require totally different mindsets.
Ooh, interesting. So it's not enough to just hit it big. You got to know how to keep it right.
You got it. Think about Jesse Livermore, this legendary trader who made and lost a fortune multiple times. Compare that to, say, Warren Buffett, who's all about the slow, steady game.
Okay, high roller gambler versus the disciplined investor. I'm guessing Buffett's the one to emulate.
You're catching on. Getting wealthy, it often involves risk-taking, being optimistic. But staying wealthy, that needs humility, frugality, and remembering that what worked in the past might not work in the future.
I like that. It's like the difference between winning a poker hand and building a business.
Right.
One's a gamble, the other takes strategy and the ability to adapt.
Perfect analogy. And that's where diversification, emergency funds, and avoiding crazy debt come in. You got to build a strong foundation so you can weather any storm.
This is making me rethink a lot of things. It's not just about making a quick buck, it's about building something that lasts.
That's the spirit. Now, get ready for Chapter 6, Tails You Win. We're going deep into the land of extreme outcomes.
Tails, you win. Sounds like a high-stakes coin toss.
In a way, it is. Housel's argument is that in lots of fields, like investing, a handful of events or choices, they have a massive impact on the overall result.
So it's not about always being right. It's about being able to, like, ride that wave when those big wins come along.
Exactly. Picture a venture capitalist, they invest in tons of startups, right? Most fail, but one huge success can make up for all the losses.
Okay, I see. It's like a baseball player who strikes out a lot, but also hits those game-winning home runs. It's those moments of brilliance that matter.
You got it. And Howells uses the example of Walt Disney. He had so many flops before Snow White became a smash hit. Even the greats have failures.
Wow, that's reassuring. I mean, setbacks are part of the journey, even for legends like Walt Disney.
Totally. It's about persistence, learning from mistakes, and being ready to grab those big wins when they show up.
I love that. So it's not about avoiding failure. It's about being resilient and making the most of those unexpected opportunities.
You got it. Now, let's talk about something we all value. Freedom. Chapter 7 is all about that, and the connection between money and personal autonomy.
Yes, that's something I feel strongly about. Having that financial security, it gives you the power to make choices based on what you want, not just what your bank account says.
Exactly. It's not just about the money itself. It's about the choices it unlocks. Housel even talks about leaving a high-paying internship because it wasn't fulfilling. He chose freedom over a big paycheck.
That's a bold move, but I get it. It reminds us that money is a tool, and we get to decide how to use it to build the life we want.
Exactly. Now get ready for a mind bender, because Chapter 8 is the man in the car paradox. We're going to challenge some assumptions about what wealth really is.
A paradox. I'm intrigued. Let's peel back the layers on this one.
Okay, so we tend to think of wealth as all the flashy stuff, right?
Right.
The fancy cars, the big houses, the designer clothes.
Yeah, it's like the Instagram version of wealth.
Yeah.
All about appearances and showing off what you've got.
Exactly. But true wealth, it's often invisible. It's the things you don't see. A fully funded retirement account, a paid-off mortgage, that solid emergency fund. That's where the real security lies.
So it's more about having that peace of mind, that freedom to make choices, even if it doesn't look glamorous on the outside.
You got it. Housel uses Rihanna as an example. She almost went bankrupt, even though she seemed super wealthy. It shows that outward appearances can be deceiving.
That's a great example. It's like being rich and being wealthy are not always the same thing. It's about making smart choices for the long haul, not just keeping up appearances.
Okay, ready to get back to basics? Chapter 9 is all about saving money.
Yes, practical advice. I love it. Is this where we get into budgeting, cutting expenses, all that good stuff?
You got it. But it's not just about pinching pennies. Housel is talking about the feeling of control and flexibility that comes from saving.
Like having that buffer between what you have and what you want so you can make choices that matter to you.
Exactly. A friend of mine saved for years so he could quit his job and start his own business. It wasn't about being rich. It was about having the freedom to pursue his passion.
That's awesome. It's like savings give you options, whether it's pursuing a dream, traveling, or just knowing you've got a safety net.
Okay, ready for more practical advice. Chapter 10 is Simple Rules of Thumb. We're going to navigate the wild world of personal finance.
Hit me with those golden nuggets of wisdom.
This chapter is all about being flexible and adaptable because things change all the time, right? Housel says a solid financial foundation gives you the freedom to roll with the punches.
So it's not about following a rigid set of rules. It's about having the resources to change course when you need to.
Exactly. He gives this example of someone who had enough money saved to walk away from a toxic job, even though it meant less pay. They chose well-being over a bigger paycheck.
That's powerful. It's like having that if you fund we talked about, that reserve of money that gives you the power to walk away from something that's not working for you.
It's about saying yes to the things that matter and no to the things that don't.
Love it. It's about using money as a tool to create the life you want.
You got it. Now, things are about to get interesting. Chapter 11 is Reasonable Rational, where we're going to explore that messy intersection of logic and emotions when it comes to money.
Oh, this sounds like we're getting into the irrational side of things.
We are. We like to think we're all about logic, but Housel argues that sometimes it's better to make decisions that feel emotionally right, even if they're not perfectly rational on paper.
So you're saying sometimes it's okay to let our feelings influence our financial decisions.
Think about it. People often choose not to treat fevers, even though it might help them get better faster. Why? Because it feels uncomfortable. Logic goes out the window when we're dealing with uncomfortable emotions.
Okay, I see your point. So how do we apply that to money?
Well, take investing. Someone might choose a lower risk portfolio even if it means slightly lower returns. Why? Because peace of mind is worth more than a few extra percentage points.
That makes sense. It's about finding that balance between what's good for our wallets and our mental well-being. Sometimes that peace of mind is priceless.
Exactly. And that leads us perfectly into Chapter 12, Surprise. We're going to explore the unpredictable nature of, well, pretty much everything, especially finances.
Surprise. I have a feeling this is about those unexpected events that can throw a wrench in even the best laid plans.
You got it. Housel reminds us that history is a good teacher, but it can't predict the future perfectly, especially when it comes to things like investing, where innovation and human behavior are always changing the game.
So we can learn from the past, but we shouldn't expect it to be a crystal ball.
Exactly. He brings up the Wright brothers. When they invented the airplane, even the experts thought it was a crazy idea.
Wow, so even the smartest people can miss those big breakthroughs.
That's why it's important to be open to new ideas, to be flexible, and to accept that the future is always going to have a few surprises up its sleeve.
This makes me think about the whole internet and smartphone revolution. No one saw that coming.
Exactly. It transformed everything, and it shows how the financial world is always in flux. What looks like a sure bet today could be old news tomorrow.
So the key takeaway is to stay adaptable, be humble about what we know, and be open to new information, even if it challenges what we thought we knew.
You nailed it. And that brings us to Chapter 13, Room for Error. Time to build that financial safety net. We've got to be ready for those twists and turns life throws our way.
Room for error. Okay, I'm listening. Especially after hearing all these stories about unexpected events and market craziness, it sounds like a good idea.
It is. Housel says it's essential to build in a margin of safety because we can't control everything.
So it's not about being perfect. It's about having a plan B for when things go wrong.
You got it. He uses the example of blackjack card counters. Even when the odds are in their favor, they manage their bets carefully because one bad hand can wipe them out.
I see what you mean. Even when you're skilled and knowledgeable, you still need a buffer for those random events.
Exactly. In personal finance, that room for error might look like having a bigger emergency fund than you think you need, diversifying investments, or just avoiding those all-or-nothing bets that could ruin you.
This is a good reminder to have a safety net, especially when things are uncertain.
Exactly. Life is full of surprises, and having a plan to navigate them is crucial if you want to reach those long-term financial goals.
Okay, I'm seeing how all these chapters connect now. It's not just about crunching numbers. It's about understanding how we react to those numbers and building a financial plan that fits, like who we are and how we handle risk.
That's a great insight. Now, ready for a little introspection? Chapter 14 is You'll Change. We're going to explore how our goals and priorities shift as we go through life.
You'll change. Okay, this is getting deep. Are we talking about those midlife crises where people suddenly quit their jobs and travel the world?
Not necessarily, but it's in that realm. Housel says our goals, our values, even how much risk we're comfortable with, They change over time.
So the financial plan I had in my 20s, it probably doesn't make sense now.
Probably not. Housel uses this cute example of a little kid who wants to be a tractor driver when he grows up. It's a reminder that our dreams and priorities change as we get older.
I can relate to that. When I was a kid, I wanted to be a veterinarian. Now, the thought of dealing with sick animals all day makes me kind of queasy.
Exactly. We change, and our financial plans need to change with us.
So it's not about setting a rigid plan in stone. It's about having the flexibility to adapt as life throws curveballs.
You got it. Maybe you need to tweak your investments, change your savings goals, even switch careers. The important thing is to be open to new possibilities, and remember, it's a marathon, not a sprint.
Okay, this is making me think about financial planning in a whole new way. It's not about reaching a destination. It's about having a roadmap that can guide you through all the twists and turns along the way.
That's a great way to put it. And speaking of navigating complex terrain, we're moving into chapter 15, Nothing's Free. We're going to uncover the hidden costs and trade-offs involved in any financial decision.
Nothing's free. This sounds a bit ominous. Are we talking about hidden fees and fine print?
Not just that, but it's related. Housel's point is that anything worthwhile in finance, it comes with a price tag. It's about understanding what you're giving up in exchange for what you're getting.
So it's not just about chasing the biggest returns. It's about being aware of the risks and what you might have to sacrifice along the way.
You got it. He uses the example of General Electric, this massive company that seemed unshakable but ultimately faced huge losses. It shows that risk is always there, lurking in the shadows.
It's like the higher the potential reward, the higher the potential risk, right? It's about finding that sweet spot where you're comfortable with both.
That's a great point. And that's where Housel's idea of volatility as a fee comes in. He's saying that those market ups and downs, they're the price we pay for the potential of long-term growth.
Okay, so it's like paying for admission to the wealth-building theme park. No one likes fees, but they let you in on the fun.
Exactly. And if we can reframe our thinking about volatility, it might help us stay calm when the market gets bumpy.
This is giving me a whole new perspective on risk. It's not the enemy, it's just part of the game. Okay, what's up next?
Now we're moving into the social side of things. Chapter 16 is You and Me, and we're going to explore how other people influence our financial choices.
You and me. Sounds like we're talking about peer pressure and how it can lead us down the wrong financial path.
That's part of it. Housel says we often look at what others are doing, even if it doesn't make sense for us.
It's like that fear of missing out, that FOMO, but with money. You see your friends making bank on some trendy investment and you feel like you got to get in on the action.
Exactly. But everyone's situation is different. What works for one person might be a disaster for another.
Like the dot-com bubble, right? Everyone piled into tech stocks, and when it burst, people lost a fortune.
Classic example. It's a good reminder to think for yourself, do your research, and not get swept up in the hype. Your financial decisions, they should be based on your goals, not someone else's.
Makes sense. Okay, what else do we have in store?
All right, get ready for a dose of reality. Chapter 17 is The Seduction of Pessimism. We're diving into why negativity often seems more convincing, even if it's not accurate.
The seduction of pessimism. That sounds like a dangerous path, especially when it comes to money.
It can be. Housel says pessimism often feels more intellectual, more sophisticated than optimism.
Why is that?
All right.
We all know optimistic people are more fun to be around.
Well, pessimism often involves analyzing all the things that could go wrong, right? It plays into our negativity bias. As humans, we tend to focus on threats more than opportunities.
This reminds me of how the news always seems to focus on the negative stuff. It can make you feel like the world's ending, even if things aren't that bad.
Exactly. It's crucial to be aware of our own negativity bias and get information from a variety of sources. Just because someone sounds smart while predicting doom and gloom doesn't mean they're right.
Good point. Okay, so it's about taking a step back, looking at the evidence, and not getting sucked into all the fear-mongering.
You got it. And that leads us to Chapter 18, When You'll Believe Anything. Get ready to explore how our hopes and dreams can sometimes lead us astray, especially when it comes to money.
When you'll believe anything. Oh boy, this sounds like a recipe for falling for scams and those get-rich-quick schemes.
You're not wrong. Housel argues that when the stakes are high and we feel like we have no control, we're more likely to believe things that confirm what we want to be true, even if there's no evidence to back it up.
So, if we're desperate for a financial miracle, we're more likely to ignore those red flags and trust someone who's promising us the moon.
Exactly. He tells the story of a father who was convinced a faith healer could cure his sick son, even though there was no scientific proof. It shows how powerful belief can be, even when it's not based on reality.
Wow, that's a powerful example. It shows how emotions can cloud our judgment, especially when it comes to things that matter most to us.
It's a reminder to be cautious, especially when it comes to money. If it sounds too good to be true, it probably is.
Okay, so skepticism and common sense are key when navigating the financial world. What's next?
All right, time to put it all together. Chapter 19 is all together now, and we're going to synthesize some key takeaways from the book and look at how our individual views shape our financial choices.
All together now. It sounds like we're stepping back to see the big picture of how our minds and money interact.
Exactly. This chapter reminds us that we all see the world through our own unique lens, and those lenses are shaped by our experiences, our beliefs, and sometimes our biases.
It's like we're all looking at the same world, but through different filters.
That's a great way to put it. Housel tells a story about an alien visiting Earth after the 2008 financial crisis. The alien sees all the same physical stuff, but can't understand why everything crashed. It shows how much our perceptions influence how the economy works.
That's right. The alien's looking at the facts, but what really drove the crisis was fear and loss of confidence.
Exactly. Our emotions and the stories we tell ourselves about money, they have a huge impact.
So it's not just about numbers. It's about psychology, behavior, and like the narrative we create around money.
Exactly. It's about recognizing that our individual views are limited and that the financial world is influenced by so many factors that are really hard to predict.
Okay, so it's about being humble, realizing we don't know everything, and being open to new information, even if it challenges what we thought we knew.
You got it. And that leads us perfectly into Chapter 20, Confessions, where Housel shares his own financial philosophy and the lessons he's learned along the way.
Confessions. I'm curious to hear what wisdom he's gleaned after taking us on this whirlwind tour of the psychology of money.
It's a great chapter. He starts by saying there's no one right way to do personal finance. What works for one person might not work for another.
So there's no magic formula. It's all about finding what works for you.
Exactly. And he really emphasizes finding an approach that helps you sleep well at night. It's not about chasing the highest returns no matter what. It's about finding that balance between financial security and peace of mind.
That resonates with me. I'd rather have a modest portfolio I feel good about than stress about risky investments that keep me up at night.
Absolutely. And that peace of mind comes from knowing your risk tolerance, diversifying, and thinking long term. Focus on what you can control and don't get swept up in the daily ups and downs.
This reminds me of that volatility as a fee idea we discussed.
Yeah.
Got to be willing to ride the roller coaster if you want to enjoy the view from the top.
Great point. And it shows how important it is to have a financial philosophy that matches who you are and what you value.
Wow, this has been an eye-opening journey through the psychology of money. We've covered so much ground, from the power of compounding to the importance of accepting risk and building in room for error. But before we wrap up this part of our deep dive, I want to take a moment to highlight some of the key themes that have emerged.
I'm all ears. It's clear that understanding ourselves, our biases, and our motivations, that's just as important as knowing the technical side of finance.
Definitely. And we keep coming back to this idea of finding balance. A balance between risk and reward, saving and spending, chasing goals, and enjoying the present moment.
You're right. Financial well-being, it's not about extremes. It's about finding a sustainable path that helps you reach your goals and live a fulfilling life.
Another thing that stuck with me is the importance of thinking long-term. From the magic of compounding to writing out market volatility, patience is key.
Absolutely. Financial markets are unpredictable in the short term, but over the long haul, they tend to trend upward. It's about staying focused on your goals and not panicking when things get rocky.
And finally, we can't forget about defining what enough looks like for each of us. Our financial goals, they should serve us, not the other way around.
Exactly. Financial success, it's not just about the numbers. It's about using money to build a life that's meaningful to you. A life where you have the freedom to pursue your passions and spend time doing the things you love.
This brings up a really interesting question. How does our understanding of enough shape our financial decisions? And how do we find that sweet spot between ambition and contentment?
Those are some great questions to think about as we head into the next part of our deep dive. We'll be back soon to continue exploring the psychology of money. Hashtag TTS, the deep dive episode 2024-1209, part 2 of 3.
Welcome back to our deep dive into the psychology of money.
It's good to be back. We were just talking about how all our experiences and our own ideas about enough shape how we handle money.
Yeah, and now we're picking up with chapter 19 all together now. Housel kind of reminds us here that we don't always have the full picture when it comes to money. Okay, so, like, admitting we don't know everything, being a little humble.
Exactly. We all have our own little worldviews, right? And we tend to fill in the gaps with stories that make sense to us, even if they're not totally accurate.
I can see that. It's like trying to solve a puzzle when you're missing some pieces.
Yeah,
You try to make the best of what you've got.
that's a perfect way to put it. Remember that story about the alien visiting Earth after the 2008 financial crisis?
Yeah, the alien sees all the same buildings and stuff, but can't figure out why everyone's freaking out about the economy.
Right. It shows how much our beliefs about money can affect what actually happens.
I get it. The alien's looking at the facts. But what really caused the crisis was everyone losing confidence and getting scared.
Exactly. Emotions play a huge role, even in something as big as the economy. When people lose faith, it can set off a chain reaction, even if nothing's really changed that much.
Makes me think about those stock market bubbles, Everyone jumps on the bandwagon, prices go crazy, and then boom, it all crashes down.
Perfect example. It's like a self-fulfilling prophecy almost. People's fears can become reality if enough people believe them.
So how do you stay level-headed when everyone else is losing their minds over money?
That's where having a clear financial plan and knowing your own risk tolerance comes in. It's about sticking to your guns even when the market's going haywire or your friends are bragging about their hot stock tips.
Yeah, like don't get caught up in the hype or compare yourself to others.
Exactly. Focus on what makes sense for you and tune out the noise.
Good advice. Okay, where do we go from here?
Let's shift gears to Chapter 20, Confessions. Housel gets a little personal here and talks about what he's learned about money. It's a good way to wrap up everything we've been discussing.
I always like hearing what the experts have figured out, especially the things they learned the hard way. Makes them seem more human.
For sure. And one of the big things Housel emphasizes is that there's no one-size-fits-all approach to money. What works for one person might not work for someone else.
So he's not giving us a step-by-step guide to get rich. It's more about figuring out what's right for you.
Exactly. And I love that he talks about finding a financial approach that lets you sleep well at night. It's not about always chasing the biggest returns. It's about having peace of mind.
I feel that. I'd rather have a portfolio that feels comfortable than worry about risky investments all the time.
Totally. And that peace of mind, it comes from understanding how much risk you can handle, diversifying your investments, and thinking long term.
Right, it's about focusing on what you can control. And remembering that volatility is just the price of admission to the wealth-building game, like we were talking about before.
Exactly. It all comes back to having a financial philosophy that fits who you are and what you value.
This whole deep dive has really highlighted how much our psychology, like our inner world, affects our financial decisions.
Mm.
It's not just about numbers, it's about understanding ourselves.
Absolutely. This isn't just about learning financial concepts. It's about becoming more self-aware and emotionally intelligent when it comes to money. It's like financial well-being is about more than just your net worth, right? It's about having a life you love and making choices that feel right for you.
Exactly. It's about using money as a tool to support the life you want, not letting it rule your life or tell you what you're worth.
So we've talked about how our past, our feelings, and even who we hang out with can affect how we handle money. We've explored the power of compounding, how to manage risk, and the importance of defining what enough means to each of us.
And we've looked at how to challenge those conventional ideas about investing, how to resist the pull of negativity, and how to build a financial approach that reflects your values and who you are.
Okay, so for the last part of this episode, I want to shift gears a bit. We've unpacked a ton of information, but now it's time to think about what it all means for you, the listener.
Totally. So as we move forward, I want you to think about what really resonated with you. What surprised you? What made you rethink your assumptions? What can you take from this deep dive and actually put into practice? Hashtag TTS The Deep Dive, episode 2024-1209, part 3 of 3. All right, welcome back to The Deep Dive. It feels like we've been on quite a journey with the psychology of money, exploring all those fascinating ways our minds and money interact.
It's been eye-opening, hasn't it? From janitors amassing fortunes to the allure of pessimism. It's amazing how much psychology plays into our financial lives.
Totally. So as we wrap up, what are the key takeaways our listeners can put into practice? What are those actionable nuggets of wisdom they can take away from this deep dive?
One of the biggest things that stuck with me was the power of thinking long term. Patience and consistency, those are the real MVPs of building wealth.
Ah, yes, the magic of compounding. Small, steady steps over time, just like that snowball effect we talked about earlier.
Exactly. Remember that example. Investing $1,000 and letting it grow at 7% a year. After 30 years, it could be worth nearly $8,000. That's the beauty of compounding. It just keeps building on itself.
It's a good reminder that slow and steady often wins the race, especially when it comes to money. It's so tempting to get caught up in those get-rich-quick schemes, but this book really makes you think twice about that approach.
Definitely. And